Hey, welcome everybody. Happy Wednesday to you. Time for managing your options portfolio, which is we will do exactly just that as we go forward in this webcast. Um, I'm glad you're here. We're also going to kind of hit up another topic. I try and do a topic and manage a portfolio. We're going to do both today. And so we'll get to that in just a minute. I want to talk about, hey, what are some of the considerations when you're doing trades or managing trades as to what kinds of trades you should be in? And that can certainly impact what trades you exit as well. Now, I'm joined alongside in the chat by Scott Thompson, who's helping me out. I appreciate Scott. Between Scott and myself, we'll do our best to answer your questions as they come up. If you're watching live, if you're not watching live, we're glad to have you as well. All are welcome. And familiar names, first timers, glad you're here. You can follow us on X, that formerly known as Twitter, at BrentMooreCS, at Scott Thompson CS. And hey, let's hit up a few disclosures and then we'll get to the reason that you're all here. Options do carry a high level of risk and are not suitable for all investors. Multiple leg option strategies will involve multiple transaction costs. And the paper money software application is provided for educational purposes only. The material today is intended for general educational purposes, general informational and educational purposes only. Paper money software application provided for educational purposes only. For the sake of simplicity, I may not factor in commissions or fees in the trades, the example trades that we place, but just realize those are a thing you need to factor in. All investing involves risk, including the potential loss of principal. And in the case of short options, the risk can go up as well. So just be aware of the risks whenever you trade. Past performance is no guarantee of future results. So there we go. Let's get it started here, everybody. Let's head on over to the Thinkorswim platform. This is the S&P 500. We dipped down below the 20-day moving average. Right now, we're kind of like right at that 20-day moving average. But in general, the trend has been going up. And that leads me into what I want to talk about here. And that is, what's your market posture? Okay. So when you're considering a trade on an individual stock, very often we're going to look at three things. Okay. The first one is, what's your market posture? If you're bullish on the market overall, that very well may affect what kinds of trades you either enter or choose to stay in, or how you manage them. Maybe you're considering rolling out a bullish trade. If you have a bullish market posture, you're more likely to want to do that rather than just close it out. Okay? The types of trades you go in certainly could affect that as well. So that's kind of the first consideration I want you to think about. Number two, I want you to consider implied volatilities. What's implied volatility on the market? Well, we're going to look at that in just one sec. And then number three, which we'll get to as well, are you looking for more of a high probability trade or a high ROR, a better ROR? Because usually there's a balancing act, a trade-off between those two. Higher probability trades usually have the that sounds great. I want a high probability trade and a high return on risk. Well, the reality is usually you're sacrificing one for the other or vice versa. So it's which ones you want to emphasize. So these three things are the one kind of items I want to focus on here to start. Market posture, implied volatilities, and your choice of high probability or return on risk. And so there you go. Okay. Janelle, thank you for the feedback on that. Sorry, that actually turned out okay. Writing with this mouse sometimes isn't easy. And plus my handwriting, let's be honest, isn't the greatest in the first place. But there you go. Hopefully that's legible for you all. Okay. So there's the three things I want to kind of mention here. we mentioned market posture already. What I'm going to be talking about here is, in terms of market posture, a lot of it may come down to technical analysis. Now, there's other ways you can do it. You can look at market valuations, stuff like that. But in general, we're talking about technical analysis. What's the trend? What's support? What's resistance? Probably I'd consider some support in this area here. Okay. Why? Well, that's where the 50-day moving average is. That's where we bounced off that big down day we had on Friday. We kind of touched it yesterday, and then we're off of that as well. But the general trend, we're above the 50-day moving average. We're right at the 20-day moving average, but we've had higher highs, higher lows. I'm going to say the trend is up. And for trend traders, that's a key item for kind of deciding how to trade. There's other types of traders, so it's not a prediction of the market exactly, but we're going to go with a bullish market posture as our first thing here. Number two, I mentioned implied volatilities. What's our implied volatility? Well, I'm going to use the VIX. The VIX is a measure of implied volatility on S&P 500 options. And notice, it goes up and goes down, up and down, up and down. It's gone up more recently. Where's it going to go next? I don't know. It could go higher. It certainly could go higher. Kind of depends what happens in the market, of course. But if it does go up here, that's a thing. Here's our starting point, though. Okay. Here's our starting point. That means as compared to a lower level, say around 15, when we're at about 20, premiums are going to be higher on the options. And if it were to go down after we entered the trade, that would benefit options that have a negative vega. So vega tells us how the option trade is going to do in comparison to changes in implied volatility. Now, there's a lot of other factors that can affect an option trade, but just isolating that one factor of implied volatility, if we can sell for a higher premium and then it goes down, that is more beneficial. That tends to benefit sellers. Now, a confounding factor right now is earnings, because we can look at what the implied volatilities for the S&P 500 are, but if we have a stock that is going to have earnings tomorrow, it's likely that the implied volatilities are going to drop on that earnings tomorrow. Okay. Or if we have implied volatilities, if we look at a stock that has earnings in 3 weeks, it's likely the implied volatilities are going to kind of ramp up over the next 3 weeks and then drop after earnings. Okay. So that's a different factor. But in general, buyers like lower implied volatilities that they think are going to go up higher, and sellers like higher implied volatilities that they think are going to go lower. Let's move on to the third one. The third one was higher probability or higher return on risk. Let's just simplify this real quick. Let me just do a real simplified version. Let's say we're looking at a long put versus a short put. Okay? A long put has potentially a very high return typically on those long puts, but they have a negative time decay on them, and generally we'd consider them to be a lower probability trade. A short put, depending on what strike price you choose, may be a very high probability trade. Time decay helps you out on those, but you have very limited upside. The upside is limited on the short put to the premium that you sell. But potentially a very high downside. The more the stock goes down, the bigger the problem, the bigger the hole you can dig with those short puts there. So that's just an illustration, but each of these strategies that we look at it's going to be higher probability, higher return on risk, or maybe some kind of mix of the two. Let's do this. Let's just kind of break it down here and just talk about some different strategies here. I'm not going to be exhaustive on every strategy that I go through, but let's just kind of go through them somewhat quickly here on what some of these strategies are. What's my posture if I do a long call? Well, I think a lot of you know it's bullish. Okay, so it's a bullish posture. What is my implied volatility? Well, I'm a buyer on that. Let me think. Should I write buyer? In other words, positive vega on that. Positive vega. If implied volatilities go up, it benefits us. Okay. So ideally, start at a lower high implied volatility. If we think implied volatilities are going to go higher, then that's really the key, by the way. Not as much what volatilities are now, but where you think they're headed. Long calls, positive vega, okay, or buyer. Let me just do instead of buyer because it gets confusing with vertical spreads where we're both a buyer and a seller, but positive vega. Okay, so let me just say instead of buyer seller, let me change that here. Vega is positive. Okay. Better probability or better ROR? We're not emphasizing probabilities on a long call. We're emphasizing ROR, return on risk. Okay, let's go to the next one. Let's do a different one. What if I do a long call vertical? Bullish or bearish? I'm bullish on a long call vertical. Bullish. Vega, it just depends on the strikes. It just depends on the strikes. So I'm not going to put a plus or a minus there. I'm just going to put a 0 there, okay? It really just depends on the strikes. Better probability or better return on risk? It's really a mix. Again, it's kind of a mix. It depends on the strikes you choose. So we can make it a higher probability trade, or we can emphasize return risk. So I'm going to put a 0 on that as well. Let's move on to a short put vertical, and I'm just going to say out of the money, OTM next to that. Out of the money. What's going to happen? Is that bullish or bearish? That's bullish. If you haven't caught on, I'm starting with the bullish trade right now. What's my implied volatility? My implied volatility is negative if it's out of the money. Now, if it's not out of the money, that can shift. But typically the way we teach them in this webcast is we're doing them out of the money. So negative vega, we benefit if implied volatilities go down on that. Are we emphasizing returns or return on probabilities or return on risk? We're emphasizing probabilities on that trade. Okay, let's go to the next one. Okay, what about how about let's see. What about a long synthetic? Okay, long synthetic. Okay, bullish or bearish? It's bullish. What's our implied volatility? Typically, our vega is going to be pretty close to 0 on a long synthetic because we have a long call, we have a short put, they offset each other, so not much implied volatility impacts. Probability or return on risk? Really, we're emphasizing the return on risk on those. So it doesn't have a negative time decay, so the probability is probably not terrible on that. It's not terrible, but it's kind of in some ways similar to stock. Now, long synthetics are not stocks. For example, they have expiration dates. We don't get dividends, stuff like that. Okay? So there we go. Let's go on to the next strategy. Let's move on to a bearish strategy, a long put. Long put. Bullish or bearish? We're going to go bearish. Okay, long puts are bearish. And implied volatilities, positive vega on those. Let's do a positive vega here. Positive vega. Are we emphasizing probability or return on risk? Well, let's emphasize our return on risk on that. We get a better return on risk on that. Let's go to the next one. A long put vertical. Long put vertical. It's bearish. It is implied volatilities. It just kind of depends on the strikes that you're using. And it's going to be kind of a mix of the return on risk or probability on that. What about a short call vertical? Out of the money. OTM, bullish or bearish? Well, it's going to be bearish. Our implied volatilities are going to be negative. In other words, we're Vega negative on that, and we're emphasizing probabilities on those. Probabilities. So, and let's do one more. Let's say a short synthetic that is going to be buying a long put and selling a call. That is a bearish strategy. Our Vega is going to be largely neutral, and I'm going to say that's going to emphasize the return on risk. Okay? R, O, R. Okay. All right. So that's that. Now, there are neutral strategies in here as well. So, for example, calendar spreads are neutral. You can do that. Butterfly spreads are typically kind of neutral. Iron condors are typically kind of neutral. They're implied volatilities, so let me just do those real quick. We're going to do calendar. Iron condor and butterfly. These are all neutral strategies. Now we can skew them a little more bullish or bearish depending on the strikes. But in general, we're going to consider those more neutral. And butterflies, more neutral. Okay. The thing that distinguishes these partially is your implied volatilities. So what's your Vega on these? In the case of a calendar spread, well, in terms of time decay, it's a positive theta trade. It's a Vega positive trade as well. We benefit if implied volatilities go up. Butterflies and iron condors both are Vega negative trades though. Okay, so let's do negative there and negative there. Are these big gainers though? No, typically not. Typically we're going to emphasize probability on all those neutral trades there. Okay? So let's, I'm going to call that good for the table here. But just want to say, when you are looking at these, ask yourself those three questions. What's your overall market posture? What's your implied volatility, your Vega on these, and are they better probability or better ROR? Now, let me shrink this down just so if you wanted to take a screenshot, you could. Hold on, let me just see if I can get this on one screen. There we go, I think that's it. So if you wanted to do a screenshot, let me get rid of that little thing. Whatever, I don't know what that line is, but there's the screenshot if you wanted to do that. Okay. So, or take notes, hopefully. If you're watching on a recording, you're welcome to take notes on that. So I'm going to go off of this. We're going to go back to the the Thinkorswim platform, and let's talk about trading this. Now, as I mentioned, there's some earnings can certainly make a difference on these. Let me take an example. Here's a stock. Let's look at Apple for a sec. Here's Apple. If we have earnings coming up, well, I'm not seeing earnings here. How can I find earnings? I can simply find earnings if I just go to the Analyze tab, go to the earnings, it says October 30th. So any trade that I'm looking at here on this, it's likely if I look at implied volatilities, before earnings, they're likely to go up before earnings and then drop down after earnings. Okay? So let's do it. Let's look at, so earnings has gone up, and if they're dropping, that is, right now we had a big drop on Apple, along with a lot of the money market, and the implied volatilities are dropping as well here. But given that earnings is coming up, it's likely implied volatilities will stay higher. Let's go to JP Morgan. JP Morgan just had earnings, and the stock, our implied volatilities have dropped with earnings, no doubt. And if implied volatilities of the overall market are looking to drop, if implied volatilities on each of the market as a whole, we already looked at the VIX, may drop, they may not drop, but if you think they may drop, because remember, they're a little bit higher right now, along with IVs here dropping, that could benefit more of a selling type transaction. But if you think they're going to stay higher, then we can do a different trade. But let's look at a trade on JP Morgan. First thing, am I bullish? I would say, in general, the trend on JP Morgan is this. We've bounced off that 50-day moving average here. We bounced here. We bounced off that 50-day. It has been using the 50-day moving average for support. Okay? We would probably consider this a support level here. If I want to do say a short put vertical or something like that, that would be a trade that would be bullish. It would benefit from a drop in implied volatility, and it would emphasize probabilities rather than bigger returns. That may make it be a trade that makes sense. So short put verticals are bullish, emphasize probabilities, and are negative vega on that. Let's compare that to, say, another type trade. Let's say I'm bullish and I want to, and I'm willing to give up some on the volatility. I could certainly just do a long call. Okay, that would be bullish. I'm emphasizing return on risk instead of probabilities. In other words, potentially bigger returns. And implied volatilities would be positive vega on that, but that'd be something that perhaps I'm willing to sacrifice in this case. But in this case, what I'm going to do is I'm going to do a short put vertical because I wanted something to be bullish. I want to emphasize the probability of the trade, and I want a drop in implied volatility to help me out on that trade here. And just as a reminder, this is what the current IVs look like, implied volatility looks like on this. So for short put verticals, I'm just going to kind of do our standard thing that we often do. We'll go out about a month. I'll look at 30 days here. Doesn't need to be exactly that. I'm going to go to a probability in the money somewhere around a 30 to 35% probability in the money, meaning there's roughly a 65 to 70% chance it's going to be out of the money. When I talk about higher probabilities, that's what I'm talking about here. And I'm going to look for a vertical spread here. Now, one challenge on this right now is my spreads are pretty big on this. You see that? My bid price and my ask price? There's a big difference between those. That's a call. Those are calls. Let's look at our puts. Sorry about that. I was looking at the wrong one. Let's go 30 to 35% IVs. Same thing over here. Big spreads on that. Open interest, I mean, so-so open interest, but those spreads are big and are probably disqualifying of that. Therefore, what I'm going to do is I'm going to go out 37 days instead. 37 days. And John's list has a question. I'll get to that in just a sec. Look, when we go out the monthly options, okay? And so instead of these that say weekly next to them, and I go to the ones that I'll go with monthly, and I look at this, and I'm going to go to that 35%. Notice how much tighter those spreads are. So I'm going to sell the 300 strike. I'm going to buy the 295 strike by holding down the control key. And then I can come here. I can click on confirm and send and just look at some of the information here on this. Max profit, 132. Max loss, 368. If I divide the max profit by the max loss, I come up with about a 36% return on risk. 36% return on risk. And so that is, that's kind of pretty standard for a short put vertical. Remember, we're not emphasizing return on risk. We're emphasizing probabilities on that. Okay, so let's go ahead. I'm going to send that trade here, and I'm just going to put that in our short verticals category, and then I want to actually go to some trade management on that. Okay, but we had a question I want to address because perhaps some of you aren't aware, didn't see the question, or are watching on a recording. The question was, how do I get these up here? All you need to do is go up to the gear right above the chart settings gear, go to My Tools, and I put it on each chart. Click on OK, and then you can add or subtract or modify by using this button right here. Whether you add studies or styles at the top of the chart or drawing tools, you can do that right there. Now, so let me just kind of summarize the first part before we go to managing these trades. Consider posture, consider your implied volatility, consider whether you want to emphasize reward or probability. In this case, our example trade, we emphasize probability. But let's look at some of these trades here. And I'm going to actually start kind of at the bottom of the list because often I start at the top and I want to make sure I hit some other things there. Remember, we got a survey link in the chat today. Appreciate if you would give me some feedback there. And, you know, not just feedback, but like ideas of things you'd like me to cover in the webcast. I'm happy to do that. Okay, let's go ahead and just look at some trades here. This is, we have some different trades that are, for example, what is this? 350 long call, 350 short put. What kind of trade is that? Okay. What kind of trade is that? This is a long synthetic. Okay, this is the long synthetic. How's it doing? Well, it's doing fairly well. Okay, it's doing fairly well. We still have plenty of time before expiration on this, so I'm not going to get out because of time. I'm not going to get out because we're losing money. Ultimately, there's a theoretical unlimited gain on this, so we haven't made as much as we can make. But if I turn bearish on this, then I would look to exit this. So let's go to UNH. So here's UNH. And am I bearish on? No, I wouldn't say I'm bearish. I'd say the general trend is going up. Anything can happen on earnings, but this is a longer term trade, so I'm not going to get out just because earnings is going up. But in general, the trend is going up. I have a stop loss on this. Is the stop loss an appropriate level on this? It has me getting out if it goes below 310. Okay, let's go and look below 310. Is this an appropriate stop? Well, maybe down here, but I think we could possibly move that stop up. So part of managing your options portfolio is moving up stops to try and protect gains when appropriate. Okay. So kind of support level. We keep moving up, support level. Now, I don't want to put my stop right here. I want to give it some wiggle room, but maybe I'll go to a more recent bounce, which is down here, and put my stop just maybe a smidge below that. So let's go here. Let me get out of that. We said we're going to go right below this support level, which was about 342. I'll just go a little bit below that to about 335. So what I'm going to do is I'm going to adjust that stop up. Let me click on this. Here's the existing stop we said, which was about 310. I'm going to right click on this. I'm going to cancel and replace this order. Well, you can't see the stop here because it's a rules-based stop, but I'm going to click on the gear. I'm going to go here, and right now it said 310. We're going to move this up to try to help. Doesn't guarantee that it's going to protect us on this trade. I mean, the stock could gap way down, way below this. It's not going to get us out at 335 if the stock gaps down to 300. But it has the potential to help us in our trade management here. So we're going to save that. We're going to confirm and send, and we're going to send that. We've just adjusted our stop up. So kind of when you're managing your portfolio, consider, even if you want to stay in it, if things are going well, you can consider moving that stop up there along the way. Okay, let's look at some others. WRB. Okay, so here's Berkeley. I've got, what do I have here? I've got a covered call. Okay, I still have 37 days to go. Typically, we'll exit these if we're under 10 days to go till expiration. The stock price right now is 76.5. My strike price is 80. So this is above where the current price is. We're doing fairly well on this. And I don't see, am I still bullish to neutral at least on this? Then I'd probably stick with it. If I turn bearish on this, I'm assuming this is going to come down and bounce at some point. Okay. If I'm bearish on this, then we'll just probably exit the trade. Because even though it's a covered call, and the call can help protect you a little bit on the downside, it's not going to give you that much protection. So if you turn bearish, then you just exit these covered calls. Okay. Now, stop. Stop's down at 65 bucks. Okay. I may move that stop up here. Okay. Let's move that stop up a little ways. And I'm just going to change that stop level there. Okay. So we just move that stop up on that. All right. Let's move forward. Let's do a, what do I have on this? Bank of New York Mellon. Okay. What is this? We've got long stock. I've got a long put. I put a protective put on this. When did I put this on? I put this back on August 12th. And we're losing money on the protective put element of it. Down 150 bucks basically on the protective put. But you know what? I wouldn't say this was a failure of a trade because we bought the stock. The stock has gone up a lot since then. And all that time we've had protection on. Now, it's not perfect protection. It doesn't guarantee we can't lose. But what it has done is it's kind of like we didn't know what Bank of New York Mellon was going to do over that time period, right? Over that time period, it's done fairly well. It's gone up. But it could have gone against us significantly. All the while, it gave me some ease of mind, some protection on that. So I'm going to continue with that protective put on there. I'm not going to get out because we still have 65 days to go on that of protection. I have the long stock. I'm still going to remain bullish on this. If I turn bearish on it, I would get out, but I'm going to stick with that right now. Okay? I'm hoping that is making sense there on that in terms of managing those. Let's look at some other type trades. Let me go here. What do I have here? On Schlumberger, I've got, that's a butterfly spread there. Now it's a skewed butterfly, but that doesn't matter right now. It's a skewed butterfly, but we only have 2 days to go till expiration. It doesn't matter whether we're making money or not making money. When we're at 2 days to go to expiration, we're getting out of these trades is our typical rules. Now, to get out of the trade, if I have a stop on there or an exit of some sort, normally what I'll do is I'll just exit it. I'll get out of that stop. I'll close the stop down, okay? So I'm going to cancel the exit order, okay? I don't have that stop on there anymore. And then I can look to get out. And so what I'm going to do is I'm going to right-click, create a closing order, and I can get out. Look, I can get out of the whole shebang if I want by highlighting those, highlighting whatever legs I want on this, or I can get out of one leg at a time. So, for example, if I wanted to trade this into just a straight bearish trade, if I got out of these short puts, for example, let me buy those back. Okay. I'm out. I've turned this into a bearish trade right now, if I wanted to, instead of the butterfly, which it was probably a little bit, it was more neutralish. So you can get out of these selectively if you want to change the nature of the trade, but I only have 2 days to go till expiration on that. So I'm going to get out of each of these trades. And I'm going to get out of each of these because we're at time. Now we can always roll. In fact, we'll look at an example of a roll here in just a sec. But I guess my point is this. If you have multi-leg option strategies, particularly if you have more than just 2 contracts or 2 legs in it, especially with an iron condor or something like that, very often you'll get out not as a whole, okay? You'll get out with pieces at the same time, okay? So let's go here. Let me go and let's look at the next one. We've got Nike, okay? Here's Nike. What have I got in Nike? This is our, what we call the poor man's covered call. It's actually a diagonal spread. We've had this long call, which has not been doing well, but we've had this short call, and we've rolled it out along the way. The question is it time to roll it again? Well, I got 23 days, so there's no urgency on that. But why would I roll it again? I would roll it if we've made most of what we can make on this trade. We sold it for 87 cents. It's now at 68 cents. So we've made a little bit on the short call, but we haven't made much. And when I say when we've made a lot, typically we'd be looking somewhere in the category of 70, 80%, maybe 90%. Usually in this webcast, I'll look at an 80% gain, but we're clearly not there, going from 87 cents to 68 cents. So we're going to just let that cook there and sit and take advantage of the time decay on that. And we may roll that out again going forward. Let's go, and we're going to get out here. Now, Greg asked a good question. What if Schlumberger were assigned on this? Okay, well, if it's assigned, you deal with it, okay? So if you have short, in the case of, it was a put butterfly on Schlumberger, that means we had 2 short contracts. Now, typically, it's going to be less likely to get assigned if you get out with more time till expiration. We let this one kind of lapse. We let this one go to 2 days before expiration. Normally, we're looking to get out with about a week to go to expiration. But if it were assigned with short puts, you end up buying the stock. You then have the stock. Probably just look to sell the stock at that point, unless you decide, hey, I just want to be long stock, then you deal with it. Being assigned isn't necessarily a terrible thing. It just means your option trade is turning into either a long stock or short stock trade, depending on whether they're calls or puts that are assigned early. And then, you have different risks at that point, but it may work for you. But normally, if you're assigned and you don't want to be, you just sell the stock at that point. Okay. Let's go here. Caterpillar. Caterpillar is a Leaps call that is doing well. Okay. We've rolled this out in the past when we hit about that 85 delta. What's our delta? Our delta is about 75. So the only reason I would get out of Caterpillar here is if I'm turned bearish on it. Am I bearish on Caterpillar? And I mean, the trend seems to be going really strong. So I think we're going to let that sit. We still have over a year until expiration on that. These are all Leaps here, by the way. Here's a Leaps put. Same deal on this. I've got a Leaps put on Coke. It's doing okay. We'd be looking to roll this if we get to about an 85 delta. We have about a 73 delta. Okay. About a 73 delta. And, we do have an exit on here. If we turn bullish on this, okay, right now it's a bearish trade. If we turn bullish, then we'd probably look to get out as well on Coke. So let's just take a look at the Coke chart real quick. Here's Coke. Yeah, I mean, it's been going down for the most part. It's retraced a little bit, but we have a stop on this if it goes above 71.80. Okay, so if it breaks against us significantly, we could potentially move that down, I'd say, though. If we call this maybe potentially kind of a resistance level along with our 50-day moving average, if we break above that to maybe, say, 69, if we break up here, maybe we get out. So what I can do is I can adjust this stop on Coke. Let's click on it, right-click, cancel and replace the order, and click on what we have, which was 71, and we said 69. So I'm going to change that to 69. Click enter, click save, click confirm and send. That's going to overwrite the old stop, the old exit order on it with the new one with the stop that has been adjusted. Okay. Now, I'm just about out of time, so I'm going to have to go a little quickly here on this to going forward here on this. Newmont. Newmont is a call leap, still plenty of time. It's doing well. Am I still bullish on it? The answer is, let's look at Newmont. Yeah, I mean, that's a pretty bullish chart. That's why we're in a call leap, is to take advantage of this. Can we move up our stop? Yeah, our stop is at 810. It's based on the option price. When I did this trade initially, and I did an 810 stop, the option was 1220, 1225. Well, this has gone up to 1887. I'm going to put my stop at about 70% of that 1887. Times 18.87 times 7 is, that's about a 1320 stop. Okay, so I'm going to move that stop up to try to help, doesn't guarantee, but to try and help protect our gains on this. I'm going to right click on this. I'm going to cancel and replace that order. And I'm going to change the stop from 810 to 1320. Confirm and send. Just make sure you read this over, make sure it makes sense. And I'm going to move, now I've just moved that stop up to try and help protect us. Okay, everybody, I'm out of time. I didn't get into all the trades. Well, we can't get into everything every week, but hopefully that gave you a smattering of managing different positions, long stocks, butterfly spreads, synthetic stocks, and covered calls along the way. Hopefully that was helpful, everybody. There was a survey link in the chat. Just remember that. Scott, thank you for helping in the chat. And everybody, we'll pick this up again next week. We'll hit a different variety of types of option trades to manage next week. Remember, when you're evaluating your option trades, consider the probabilities versus how much potential gain you have. Consider your implied volatilities. Consider your forecast. Thanks for joining me. Coming up next, we've got trading price patterns. I think Rachel Shell is teaching that one. Make sure you check that out, everybody. Have a wonderful rest of the day. Bye-bye.